Only 3 weeks ago, an obscure enterprise managed to secure a staggering $100 million investment, propelling its valuation to a billion-dollar unicorn status. This entity consists of merely 7 staff members, generates zero revenue, lacks a functional product, and relies entirely on a PowerPoint presentation, claiming their AI will transform the healthcare landscape. The founder, a 24-year-old with neither medical expertise nor an advanced degree in artificial intelligence, is selling a vision that does not yet exist. Despite these glaring red flags, venture capitalists scrambled for a piece of the pie. This is not an isolated satire. It is a weekly occurrence in the heart of Silicon Valley. To a seasoned observer, this represents the most transparent signal that we have entered the terminal phase of a massive speculative bubble, one poised to incinerate trillions of dollars in wealth. I have witnessed this cycle repeat itself 3 times. In 1999, dot-com companies with no path to profitability went public at astronomical valuations before crashing to zero. By 2021, the mania shifted to NFT JPEGs selling for millions and virtual real estate in the metaverse, fetching 6 figures, only for that market to evaporate instantly. Now, in 2026, I am observing the exact same psychological frenzy within the AI sector. Firms are injecting a Bauer into their pitch decks to command valuations that defy any mathematical logic, while NVIDIA trades at price-to-earnings ratios 5 times higher than those seen at the peak of the dot-com era. A new generation of investors is pathologically convinced that this time is different. It is a dangerous fallacy. While the underlying technology is indeed transformative, the current valuations are detached from physical reality. When such a disconnection occurs, the resulting correction is inevitably brutal, rapid, and merciless. Over the next 25 minutes, I will dissect why we are currently trapped inside the most significant AI bubble in human history. Let us dissect the cold, hard mathematics behind these impossible valuations, starting with the poster child of this era, NVIDIA. In January 2023, NVIDIA's market capitalization stood at a substantial $360 billion. By its peak between 2024 and 2026, it skyrocketed to a breathtaking $3.3 trillion, a 9x explosion in a mere 18 months. To put this into perspective, NVIDIA added $3 trillion in value, a figure exceeding the entire annual GDP of France. This single semiconductor company became more valuable than the combined might of Walmart, JP Morgan, Visa, and Johnson & Johnson. We are witnessing a hardware manufacturer being priced higher than 4 of America's most foundational, diversified, and consistently profitable pillars of industry. The fundamental disconnect lies in the multiples. In 2024, NVIDIA reported approximately $60 billion in revenue against that $3 trillion valuation, representing a price-to-sales PS ratio of 50x. For context, during the height of the 1999 dot-com mania, the average PS ratio for tech darlings was 10x. NVIDIA is currently trading at 5 times the insanity of the 2000 bubble. Optimists argue that NVIDIA is actually profitable, which is true, reporting a 2024 net income of $30 billion. However, at a $3 trillion valuation, that leaves us with a price-to-earnings PE ratio of 100x. When the S&P 500 historical average fluctuates between 15x and 20x, NVIDIA is trading at 5 to 7 times a normal valuation, even after accounting for its massive profits. The market is pricing NVIDIA as if its total dominance of the AI chip market is a permanent, exponential law of nature. History, however, dictates that semiconductor leadership is notoriously fleeting. In the 1990s, Intel was deemed invincible, yet its market cap stagnated for 2 decades as rivals closed the gap. In the 2000s, Nokia's mobile hegemony seemed absolute until the iPhone arrived, and Nokia's $150 billion value vanished into thin air in just 5 years. Technological supremacy is a temporary state, yet the market is treating NVIDIA's monopoly as an eternal certainty. It is not. This irrationality extends even further into the realm of AI software. OpenAI's most recent valuation reached a staggering $157 billion, despite an estimated annual revenue of only $3.5 billion. That is a 45x sales multiple for a company that is not even profitable. Reports indicate that their operating expenses, driven by gargantuan compute costs, hover around $5 billion annually. This means they are burning $1.5 billion a year, yet they are valued as if they were a money-printing machine. Investors are ignoring the current burn rate, choosing instead to value the dream of future scale. The contagion of overvaluation is everywhere. Anthropic is valued at $18 billion on less than $500 million in revenue, a 30 to 40x multiple. Databricks commands $43 billion at 18x sales. Cohere sits at $5 billion with revenue under $100 million, a 50x multiple. Character AI achieved a $1 billion valuation despite having mostly free users and minimal income. Perplexity is at $3 billion on less than $50 million in revenue, a 60x multiple. Beyond these names, hundreds of AI startups with zero revenue are raising capital at valuations ranging from $100 million to $1 billion. They have no finished products, only demos. No paying customers, only pitch decks. No profits, only a high-octane burn rate. This is textbook bubble behavior, mirroring 1999, when any undergraduate at URL could raise $20 million in a heartbeat. To truly understand why the current AI landscape is a house of cards, one must look past the visionary rhetoric and examine the cold, unforgiving arithmetic of the business models. Let's scrutinize the $157 billion valuation assigned to OpenAI. For this figure to be even remotely rational, assuming a standard 20x price-to-earnings PE ratio upon reaching corporate maturity, the company would need to generate approximately $7.85 billion in annual net profit. Even if we grant them a highly optimistic 20% net profit margin, a difficult feat for a business burdened by massive infrastructure costs, OpenAI would require an annual revenue of $39 billion. Given their current revenue sits at roughly $3.5 billion, they must achieve an 11-fold growth in sales, while simultaneously pivoting from catastrophic losses to elite-level profitability. The market isn't just betting on their success. It is pricing in a miracle as a certainty. The primary obstacle to this profitability is the staggering cost of simply staying operational. The unit economics of large language models, LMs, are a nightmare for traditional scaling. Every single query processed by ChatGPT carries a compute cost ranging from 1 cent to 4 cents. When you scale that to 1 billion queries a day, the bill reaches between $10 million and $40 million every 24 hours. That translates to an annual compute-only expenditure of roughly $3.646 billion. When you layer on the talent war, where top-tier researchers command salaries between $500,000 and over $2 million, alongside the costs of global data centers, cloud credits, aggressive marketing, and administrative overhead, the total operating expenses soar to between $5 billion and $8 billion annually. This explains the paradox. Despite generating $3.5 billion in revenue, OpenAI remains a financial sinkhole, losing $1.5 billion a year. Profitability only becomes possible if revenue grows by 300% to 500%, or if compute costs plummet, neither of which is a guaranteed outcome in a hyper-competitive hardware market. Furthermore, we must address the moat problem, or the lack thereof. In 1999, the barrier to entry for a website was low. Today, the barrier to creating a competent AI model is similarly eroding. The fundamental transformer architecture that powers the likes of ChatGPT, Claude, and Gemini is not a trade secret. It is based on open-source research and published academic papers available to anyone with an internet connection. The three traditional pillars of an AI advantage, proprietary data, massive compute power, and elite talent, are rapidly becoming commoditized. Public internet data is a finite resource that everyone is already scraping. Compute power can be rented from AWS, Google Cloud, or Azure by anyone with sufficient capital. Talent, while expensive, is highly mobile. Researchers frequently jump ship for higher compensation, ensuring that intellectual property is never truly locked down. Consequently, what prevents a competitor from cloning the core functionality of ChatGPT? The answer is nothing. We are seeing this play out in real time. Meta has released Llama as a free open-source alternative. Google has Gemini. Anthropic has Claude. Mistral, Cohere, and Inflection are all in the race. There are currently over 50 major companies building LLMs that are essentially indistinguishable to the average user. When multiple players offer a nearly identical product using similar architecture and the same data, the market inevitably shifts toward a commodity structure. In such environments, prices do not stay high. They collapse toward the marginal cost of production. Profit margins are squeezed to zero as companies engage in a desperate race to the bottom to capture market share. History provides a clear map of this pattern. Hundreds of search engines launched, but only Google survived with a real business model. Hundreds of social networks emerged, but Facebook became the dominant victor. From e-commerce to ride-sharing, the winner-takes-all dynamic ensures that while the technology may change the world, 90% of the companies attempting to sell it will be worth absolutely nothing within 5 years. The market is currently valuing every AI startup as a future champion, but mathematically, most are already dead on arrival. The second major fracture in the AI narrative is the fragility of its revenue models. Currently, the industry relies almost exclusively on a subscription-based framework charging individuals $20 a month for pro tiers of ChatGPT, Claude, or Gemini, alongside API fees for developers. However, we are rapidly approaching a ceiling known as subscription fatigue. While users were initially happy to pay for the novelty of a chat-based assistant, the long-term value proposition remains shaky. This is compounded by a brutal race to the bottom in pricing. When Meta releases Llama as a high-performance, open-source model for free, and Google integrates Gemini into its ecosystem at no additional cost, the willingness of consumers to pay a monthly premium evaporates. We are witnessing a repeat of the streaming wars, where intensified competition drives prices toward zero, turning AI into a low-margin utility rather than a high-profit luxury. Furthermore, the enterprise revolution promised by AI enthusiasts is facing a harsh reality check. Corporate adoption is currently in an experimental pilot phase, which is vastly different from permanent, large-scale integration. Many Fortune 500 companies are realizing that the return on investment, ROI, is elusive. If an AI tool requires constant human oversight due to persistent hallucinations and errors, the promised productivity gains are often negated by the cost of the subscription and the salaries of the human-in-the-loop verifiers. This pattern of disillusionment is a well-documented graveyard for tech trends. We saw it with 3D printing, which was supposed to revolutionize manufacturing but ended up as a niche tool because it was too slow and expensive for the mass market. We saw it with VR and AR, where Meta, formerly Facebook, burned $36 billion only to find that people found headsets uncomfortable and lacked compelling use cases. Most recently, blockchain enterprise solutions were the darling of consultants in 2017, only for those pilots to be quietly shuttered when companies realized the technology didn't actually solve their core problems. AI is currently a solution looking for a problem, and if ROI doesn't materialize soon, corporate contracts will not be renewed, and the revenue floor will drop out from under these multi-billion-dollar startups. To understand the timing of the impending crash, we must map these events onto the 5 stages of a tech bubble. a cycle that has repeated with surgical precision throughout history. Stage 1. The innovation phase 1-2 years. A genuinely transformative technology emerges like Netscape in 1994 or ChatGPT in 2022. It is not a scam. The potential is real and legitimate. Stage 2. The hype cycle, 1 to 2 years. Media coverage becomes relentless. Every CEO mentions the technology in earnings calls to boost stock prices. FOMO, fear of missing out, takes over, and AI-powered becomes a mandatory marketing tag for every product, no matter how unrelated. Stage 3. The euphoria peak, current state. Valuations detach entirely from fundamentals. We see 7-person companies worth $1 billion. Proponents argue that old rules of math no longer apply and that we are in a paradigm shift. Skeptics are mocked as Luddites who simply don't get it. Stage 4. The crack, expected 3 to 6 months. A specific trigger, perhaps a major earnings miss or a high-profile technological failure, breaks the spell. Smart money begins a quiet, rapid exit while retail investors buy the dip, convinced it's just a temporary correction. Stage 5. The collapse, 1 to 2 years. Reality sets in. Funding dries up, and the 80 to 90% of companies that were built on hype rather than profit go bankrupt. Trillions in paper wealth vanish as the market realizes the emperor has no clothes. To navigate the current AI climate, we must study the ghosts of the dot-com era, as they provide the most accurate blueprint for our future. Between 1994 and 1996, the Internet was a genuine world-altering innovation. By 1999, however, it had mutated into a psychological contagion. We saw companies like Pets.com IPO with negligible revenue only to spend $27 million on a single Super Bowl ad, and eToys reach a market cap of $8 billion, surpassing the established profitable Toys R Us. When the crack arrived in March 2000, the Nasdaq didn't just correct. It liquidated. Over $5 trillion in wealth evaporated. Yet the Internet was real. The technology survived, but 90% of the companies did not. Even the winners, like Amazon, suffered a staggering 95% peak-to-trough decline before eventually becoming the titans they are today. Based on these recurring historical frequencies, the AI timeline is nearing its terminal velocity. If 2023 was the year of innovation and 2024 to 2025 was the era of peak hype, then mid-2025 to early 2026 represents the euphoria peak, the very moment we are in now. The crack is mathematically projected to appear between late 2026 and early 27. The catalyst could be anything. A plateau in model performance, GPT-5, failing to impress. A major regulatory crackdown following an AI-induced disaster, or a deceleration in NVIDIA's data center revenue. Once the narrative of infinite exponential growth is punctured, the collapse will accelerate through 2027 and 2028. As an investor, you must identify the leading indicators of implosion before the crowd. Watch for 3 critical sell signals. 1. Slowing user retention. If ChatGPT Plus subscriptions plateau, it proves the technology is a novelty rather than a utility. 2. The NVIDIA miss. As the canary in the coal mine, any downward guidance from NVIDIA suggests the infrastructure spend is drying up. 3. Aggressive insider selling. When CEOs and founders dump 50 to 75% of their equity at current valuations, they are signaling that the peak is behind us. To protect yourself and profit from this inevitable cycle, you must transition from a speculator to a strategist. If you currently hold AI-exposed stocks, implement a disciplined exit plan. Use trailing stop losses, 20 to 25%, and take profits incrementally. Do not get caught in the "this time is different" trap. For those with a long-term horizon, the smartest move is to hold cash and wait for the carnage. The ultimate opportunity lies in buying the survivors companies like Microsoft, Google, or Amazon, when they are trading at a 50 to 70% discount during the 2027 to 2028 wipeout. Just as buying Amazon at its $6 bottom in 2001 would have turned $100,000 into millions today, the AI crash will create a similar generation of wealth for those who have the patience to stay on the sidelines while everyone else is applauding. In conclusion, we are watching the final act of a play that always ends the same way. The AI revolution is legitimate, but the current valuations are a collective hallucination. You have roughly 12 to 18 months to position yourself defensively. When the curtain falls and the theater starts to burn, you want to be the one standing safely outside with the capital ready to rebuild, not the one still trapped in the front row. History doesn't repeat, but right now it is rhyming perfectly with 1999. Position accordingly.